let's wait for just one more minute, baby, till we're complete. Okay, yeah, let's start. Welcome to the first guest lecture we have together. Okay, a few more students coming in. Yeah. Okay, welcome to the first guest lecture. We had also the first coaching sessions before with Robert or me. And yeah, well, that's the first guest lecture now on cash flow forecasting. I will share my screen. I think you should already have received the presentation. Okay. Okay. So the plan for today's guest lecture is that we yeah, follow or guide you through what you will be doing then with your company regarding the cash flow forecasting. And we will give you some theoretical background and mostly some guidance on the practical application. Okay. We'll start with a short introduction and then we'll discuss financial planning, basics, assumptions, applications, where I will show you a well, a basic financial model, which yeah could be like a blueprint for you also when you do your financial model for the business plan. And then we'll have some examples and some concluding remarks. Okay, let's start with the introduction. As you already might know, DCF valuation, discounted cash flow valuation, basically values an asset or a company based on expected future cash flows. And for that, we basically have to consider growth, risk, and of the specific asset or the specific company. And well, for that, it's basically very important to know the lifetime of the asset for DCF valuation, lifetime of the asset, then the cash flows, which will occur during the life of the asset. And then, of course, we need a risk-adjusted discount rate to discount those cash flows. And you see here also the net present value equation, which is basically discounting all of your future cash flows, including if you have a terminal value, then also including the terminal value cash flows. And then you would discount them with the risk adjusted discount rate. And today we will focus on the first part of the equation on the cash flows. And it's very important if we talk about cash flows that we differentiate between the different kinds of cash flows there are. The most prominent one is probably the free cash flow, which is used, for example, in the APV or the WACC method. Um, and the free cash flow basically belongs to both equity and debt investors. And that's a very important characteristic to always remember, because this cash flow is yeah, it's fully distributable to both equity and debt investors. And you would basically plan the free cash flow, um, yeah, based on a business plan. So you would create a business plan. You would yeah, make sound assumptions regarding revenues, EBITs, and so on. You have to think about growth and so on. And based on the business plan, you would then calculate your free cash flows, and yeah, you would then use those cash flows, discount them if you use, for example, the APV and or the WACC method. If you want to directly estimate the equity value of the company, you could, for example, also use flows to equity. Flows to equity only belong to equity investors. And the big difference is therefore that you would deduct any flows to debt from the free cash flow. So that's basically just the remaining cash flow if you deduct flows to debt from the free cash flow. And for that, you would typically also depend on a business plan. Um, and another, yeah, important type of cash flow are dividends. Yeah, dividends basically only belong to shareholders, and they are not always dependent on the actual cash flow. So a company, for example, could have a very high flow to equity, a theoretical flow to equity, calculated from your business plan, but then the company maybe just decides to pay, I don't know, a dividend of 10 cents a share, for example. So dividends are also driven by other factors, and yeah, company or yeah, company specific, and also like political factors. Um, and it's always important also that, for example, minority shareholders don't really have any power to influence the level of dividends, and therefore could be tricky to do a valuation using only dividends and not cash flows derived from a business plan. Yeah, but just a short note. And it's also um, important to know which databases you could use to derive your business plan, for example. And because as you can see, for basically all of these different types of cash flows, you would require a business plan, or it's better if you have a business plan. And that's also the focus of our session today, to look at what you would need to do, what steps are necessary to really derive a suitable business plan for valuation purposes. And yeah, what's also very important here is if you think about the DCF equation, then typically the cash flows have a much more significant impact on the company value than just the cost of capital. So cost of capital are very important, but if you think about, for example, you have cost of capital of 8% or 10%, it has an impact. But um, if you have cash flows of 100 or of 50, then cash flows just have a much higher impact on the company value. And typically you have also much higher variation, for example, in cash flows than in cost of capital, at least if you derive cost of capital as we would do it, and we will discuss how we would do it in the next session. Okay, regarding the business plan, what actually is a business plan? Business plan is quite or could be a quite huge data set or assumption set, which covers an action plan, for example, regarding responsibilities in a company, goals, deadlines, chances, risks. It's basically also covers a description of the company. What's the history? What does the company do? What is its strategy? It covers typically markets, the USP of the company, for example, what is the business opportunity? It includes, of course, operations. Do you make products or buy products? The organizational structure, who runs the company, who is in charge of what, basically, marketing and sales, and the the most important part for us basically are the financials then, which are of course also part of a typical business plan. And for valuation purposes and for this session, we will focus on the financial business plan. And but you can see here basically that a business plan is more than just the financial numbers. It's more like putting really the ideas into numbers. And you see here, for example, also for which purposes you would need a business plan other than just deriving cash flows. And there it's always important that you need to have you need to keep in mind what is the purpose for the business plan, because each purpose basically addresses a different audience. If you think about, for example, a startup which needs to secure seed financing, they will give you a probably quite different business plan than a mature company which strives for debt financing. Or if you want to go public as a company, you would be required to have a quite quite big business plan, including all kinds of different numbers, data, and so on, required by authorities, regulations, and so on, compared against to the startup who just wants to find a business angel. And so financing, that was basically one of the main purposes for a business plan, and but it's not the only purpose. You could also or you will need a business plan for company steering, for example. So if you have a mature big company, then a business plan is really key to manage all the different departments and so on, that everyone knows what it's going to happen over the next year, the next years. And you can, of course, then monitor by comparing the business plan figures to the actual outcome, for example. And what's also important, business plan is also needed for reporting purposes. For example, for IFRS reporting, you have to perform impairment tests, sometimes on a yearly basis. And for that, you are required basically to calculate the value in use, for example, or the fair value less cost of disposal. And for that, you typically also need a business plan, or also for purchase price allocations. If you buy another company, then you will have to report the consolidated figures in your financial statement. And for that, it's always necessary to have a business plan. Yeah, here also you see a different illustration regarding the life cycle of a typical company. And there you also see, for example, business plan focus in the first stage, secure seed financing. In this startup phase, you typically are developing your product, you're developing the marketing concept, maybe start production. And there you typically, for example, have operating losses. And that's always important. If you see, for example, the business plan of a startup, you won't really have historical numbers, or you could rely on, or also the first years of operations basically produce losses. So it's always important to remember which stage of the life cycle you're in, because, for example, in the next stage, you would then have operating profits, and you would see the expansion of your sales channels, product optimization, and so on. You will set new strategic goals, expand to new markets, and so on. So a business plan in this stage of the life cycle typically looks completely different to a business plan in the startup phase, or then in the mature phase. In the mature phase, where you have then hopefully a quite big company, an established product line, the business plan is more needed for corporate management, accuracy of your planning, and so on. So yeah, just keep in mind, for business plan is not only needed for different purposes, but it also looks quite different depending on the the business life cycle and the stage your company is in. Okay, I think that's it for the introduction. Yeah, Robert, what about the basics of financial planning?
Great. Lucas, thank you so much. We'll now have a quick look into we call it basics. So mainly the main framework of financial planning. When we go to the first slide, I think the first idea is really that when you present a business plan, and especially when you present your forecasts or projections on cash flows or earnings, incomes, whatever, what you do is you're really telling a story, right? So it's not about the numbers themselves, it's rather about the assumptions behind those numbers and the idea behind those numbers. So whether your assumption, so basically whether your revenue is 10 or 12, I think when it comes down to forecast of 2-3 years ahead, no one really can tell. But I think it's not really about the exact number. It's really about, again, the story behind it and the assumptions you make. And so what you want to do is you want to derive solid and convincing assumptions, and really make sure that you can tell those assumptions and you can present those assumptions in the way that your opponent will go along with that and understand where you're coming from and understand that it's the entire system of it, right? So I think that's the first. So when we go one step further, how can we derive solid business plan assumptions, right? And we can go to the next slide. Perfect. So it all starts with your understanding of the business model. I think in all four groups today, we already discussed the importance of the understanding of the business model. Because based on your understanding of the business model, you can really see what are the products, the services of the company, what is the revenue model, what are the income streams, and what is the profit model, right? And this is important because based on those key value drivers, so the key success factors for the company going forward, you can then decide on which of those key factors you really put your emphasis on. Because in the end, you won't be able to forecast all of the line items in your income statement and balance sheet in detail, right? That's not, I think, it's not possible and it's not necessary to do that. However, on the other hand, you will have to be aware of the main factors and then come up with a solid assumption story for those factors, right? So we discussed it, for example, we discussed it today, for example, when you think that for your company, the brand and image is one of the main factors that's driving the business and driving the value, then you should really think hard about it, and how it's going to be in the future. And maybe you argue that, you will see an increased marketing spending or selling expenses in the future because your brand is so important, right? Um, then second step after understanding that the business model, you start analyzing the company and especially the financials of the company. So you know a little bit about what are the products, where what is the legal structure of the company and so forth. And then you move on to analyzing the financials, because equipped with the knowledge of the business model, you will be able to understand the financials and understand the development of the financials. For example, you see that there's a drop of 30% in revenues and profit from one year to another. And then you say, well, that's because they carved out one of the business lines, right? Or there's an increase in investments and marketing expenditures in one year. And then you say, yeah, that's because they opened up a new, or they entered a new market, a new region. And therefore they, had to spend a little bit more on advertising and market entry costs. Um, so all this, because otherwise you will just look at the numbers and you won't be able to really understand the numbers and interpret the numbers, right? So again, you start by looking at the income statement, you start by looking at the balance sheet. And of course, with the balance sheet, you want to understand what's the line items, the main line items are about. Again, you won't go into detail in every single line item, but you focus on the really important line items. And if you see that there's this one big liability you're not really familiar with, then you have to go dig deeper and understand it. When it's just a minor or marginal line item, then you say, well, I know that I'm not really aware of that, but I think that's okay for the most part, right? Keeping a perspective, I think, is important. And then, of course, you go on with the income statement. You look into the historical development. How did the top line develop? How did the bottom line developed? What were the factors influencing this development? And then after, so to say, having a good view on the company, you will move one step further and you look into the environment of the company. And the environment of the company starts, of course, with its competitors. So you can look at, for example, comparable companies. We talked about this with Puma, for example. I think there are quite a lot public companies out there that are quite comparable to it. So you want to know not only how your own company developed, but also how competitors or comparables developed, in order to, again, put those information into perspective. And then you go one step further. It's not only the direct peers or direct competitors, but it's also the entire industry. So maybe there are any kind of trends that you're seeing, right? We talked about this in the automotive industry. There's, of course, this trend um, into e-mobility or car sharing, right? And then you ask yourself the question, how will this trend influence my company, in a sense that how it will influence my future income or my future cash flows, right? And then you may not forget that apart from any kind of trends originating with customers, for example, customer and shifting customer sentiments or so forth, there's always regulation. And sometimes you have to keep regulations also in mind. For some industries and business models, it might be very important. For others, it might not so be important. Looking into, for example, um, again, the automotive industry and the upcoming greenhouse gas regulations or anything like that. So you might want to factor that in as well, right? And then, of course, at the biggest scale, so to say, you have the economy where you look into, any kind of general economic developments such as inflation or unemployment or whatever. Um, and again, just to make sure that you get all the important in all the important factors, right? For example, you say that, well, I know that inflation sorry, that unemployment is not such a big factor, but I would like to look at material prices a little bit more, because material prices are one of my driving factors. Coming back to the business model. So in the end, and this is where I'd like to go here. In the end, you gather all the data points you have, right? And you can collect in order to inform your assumptions about the business plan and about the forecasts, right? And ideally, you have your business plan and your income statement, and you go through line by line, and you say, first of all, is it important, yes or no? And if it's important, then secondly, you go, okay, what kind of assumptions can I come up with? What assumptions would make sense, and how can I back these assumptions up, right? By data from historical analysis, from analysis of competitors, from analysis of the economy and so forth, right? And then the result will be your financials, right? Your cash flows. So you start with the assumptions and you end up as a result with your cash flows. Okay. Perfect. Then we can move on. So the level of detail, just very quickly. Again, first of all, keep in mind that you want to focus on the key driving parts, the key factors, not every single detail. Sometimes it's okay that you don't understand any kind of provision that's on your balance sheet, but you want to make sure that if there's you got the major parts. And then, of course, we also touched on it. You can think about not only looking at the company on a consolidated basis, on an overall basis. So take, for example, SAP. You maybe you want to go a little bit deeper and split the company into the different business lines, if that makes sense, if this is necessary, because you want to have separate assumptions for the separate business models or business lines. Same would be valid, I think, for Siemens, for example, the industrial conglomerate, where you have totally different business lines, right? But that depends on the company itself. All right. So then move on, and I think this is just one idea. Sorry, this is just one idea we wanted to present you with, and keep in mind that the idea of an integrated business plan, and I will get to it what it means, but the idea of an integrated business plan is important for us because we have a very specific view on valuation, and we really like to have an integrated business plan. However, there are other approaches to valuation where you would argue that you don't need an integrated business plan. Just keep that in mind. So what is an integrated business plan? Well, it's basically the integration of the balance sheet, income statement, and the cash flow statement. So starting with the valuation, you might argue that, well, I only need a cash flow. And that's true, but in the end, your cash flow should be based on an income statement and a balance sheet, right? And the reason for that is that you can, by this, you can really make sure that you got all the different developments and all the different effects that you expect from the for the company in the future, right? Because when you only look at the cash flow and you might say, well, I just look into, you know, EBIT, working capital, and capex, then you might miss some of the maybe important effects, right? And we think, especially for the case study, it's a very good exercise for you to start with the historical income sheet and balance sheet, then develop a plan for the income sheet and the balance sheet. And then based off of that, you calculate your cash flow statement, and then you can start with the valuation. Believe me, once you go through all the statements, you will know and you will really feel that you have an understanding of the company, right? Because you have to actually, well, let's say, take on all the different line items, right? Um, so that's the idea of an integrated business plan, and then we come to another, let's say, idea or question, um, and this is a very important question, because the question is, how long will your business plan be, or how many periods or forecasting periods you will have in your business plan. And I think that the proper answer is, it depends. Well, um, just to give you a short idea of what you could do is, you start with the traditional phase one, which is 2 to 5 years, and this is your let's say, short-term future, where you will be able to make comparably detailed assumption of the company, right? You might already know that there's a new factory coming up, or there will be a new factory built in one country, or that, the company will demerge one of its business lines or whatever. So you will be able to make rather detailed assumptions. Um, and after that, at the end of phase one, the company should be in a kind of a steady state. Meaning, after that, after you included all the or considered all the significant changes in the business, right? Again, if there are any changes to be considered, after that, the company should be in a steady state, meaning that after the phase one, it will presumably only develop on a constant basis, meaning either it stays constant, or it just constantly grow at a constant growth rate, right? And this is very important. So then you would be entering directly phase three, right? Which is the terminal value. I guess you heard about it in the lectures. So this is the assumption that the company will develop constant, or remain constant, or with constantly growing cash flows, right? In between the two, you can opt for a phase two, right? It is not necessary to have a phase two, but you can do it. In phase two, what you want to reflect is that basically everything will stay the same. So meaning your margins and revenue growth and so forth, they will all stay the same, or develop very constantly. But there's one or two factors you want to model, right? You want to explicitly address, and everything else stays basically the same. So this can be, for example, that you have a constant revenue growth of 2%, and then you say, well, the margin, the profitability at the end of phase one is comparably high, right? So I assume that over 10 years, the profitability reverses to the mean industry, for example, and therefore everything stays the same. You have a revenue growth of 2%, and your profitability decreases from, I don't know, 15% to 10%, right? And only then you assume a terminal value. Okay. Um, this is just optional. In some cases, it would make sense, especially looking at your case study. Maybe you want to opt for only phase one, and then directly for the terminal value. That's really up for let's say, it depends on the case. It depends on the case. All right. And lastly, I think we addressed most of those. Again, we called it here or labeled it sources. So there are so many sources where you can get information from. And again, you want to have as many information and data as possible to make your case for your business plan, right? Because you kind of want to convince the others of your assumptions. And of course, you start by the company, you go to the competitors, you go to analyst reports, equity reports, not only of your company, but also of the competitors. You look into industry reports, but also, again, you want to look at, for example, any kind of governmental official sites, any kind of regulations and laws. Maybe they are important for you, right? And so again, you can spend hours on this. Focus on the main key value drivers and try to come up with as many data as possible, and then you're good to go. Perfect. Lucas, you want to continue with the assumptions?
Yeah, sorry, I was on mute.
No worries.
Yeah, let's continue with the assumptions behind, or financial planning assumptions. Here you would see well, more from a technical perspective, which positions or which categories you would need to plan for your business plan. For example, here on the profit and loss statement side, you would have, yes, top line item, the revenue planning, of course. Then you would have your costs planning, cost of goods sold, personal costs, other costs, maybe taxes. That's basically the profit and loss side. And then you have the balance sheet planning with your working capital planning. There it's important that changes in working capital go directly into your free cash flow. And then, yeah, you have also like other provisions, sometimes minor positions in the balance sheet. You would plan them in a like fully fledged business plan. For the case study, it's not necessary to plan every single line item. So that means also for the balance sheet, for example, if you have SAP as a company, um, there I assume that you have many different line items, and there it's only important really to focus on the big line items, the most important line items. So you don't need to plan every provision position in the balance sheet. Yeah, just focus on the most important ones, the big ones. You have in the balance sheet planning typically also your dividends, dividend planning, as changes in equity, for example, or reflected also in changes of equity. And what's then also very important for valuation purposes is the investing. So you would need to plan your investments in yeah, property, plant, and equipment, for example. Depends also on the company. In some industries, you have quite high property, plant, and equipment. There you would have high levels of investments, and yeah, those investment assumptions also go directly into your free cash flow. It's also important to remember. And of course, you have your financing. So depending whether you're equity financed or debt financed, you would, or the financing assumptions need to be reflected in the business plan. Meaning you would, for example, plan a certain level of debt bank loans, for example, um, or you would plan a certain level of equity, meaning you would plan your dividends, you would have your net income, and depending on those positions, your equity would evolve over time, basically. And this is really from a technical perspective, what you would have to plan in the business plan. But how do we do that, or what is then the basis for all of these assumptions we need to make? Um, well, typically we start with historical data. So one of the first steps, if we do the business plan, is that we look into the historical figures and identify the key value drivers. This is quite different depending on the industry and company. Um, yeah, but it's really important to identify key value drivers. And this is then also like a starting point for the plausibility assessment of the business plan. Many analysts, or for example, we at KPMG, we typically assess whether the business plan seems plausible compared to historical figures. And yeah, so it's always good to keep in mind that you will be measured against the historical level. For example, if your company has had EBIT margins of 10% in the last 10 years, then, and you plan 20%, then everyone will ask you why there is a change, for example. So you really the historical level is the first benchmark. It's also like a company specific benchmark, taking all the company specifics into regard. And then also like you have the strategic analysis. You will look at the macroeconomic environment, market competition, um, and yeah, you will also do your company analysis regarding underlying earnings, which are basically just normalized earnings, free from extraordinary effects. You could do your deviation analysis. So you could really look at the business plan, the historical business plan compared to the actual outcome. And as a company, you would do that also like this is then a monitoring that you would create a business plan, and in 1 year you would assess whether you yeah whether your actual figures match to the business plan figures. You could do a SWOT analysis, for example, in the strategic analysis, and yeah, a lot of other different business strategy analysis regarding financing strategy, investing strategy, and so on. And what's also important here, as Robert mentioned before, you would define your planning period, whether it's, for example, 3 years, 5 years in your detailed planning, yeah, or any other um, yeah, planning period length. For example, if you think about utility companies, um, they sometimes have business plans for the next 50 years, or for oil fields, for example, oil and gas fields. You would also have very long business plans compared to certain industries where 3 years is the standard. And then based on these analysis, you would then really create the integrated business plan with your P&L, balance sheet, and cash flow statement. And um, yeah, you have here also some more um, sources you could use, some more analysis you could perform um, in the so-called fundamental analysis. Um, a DCF valuation is basically a fundamental valuation method. So you really look at the company and do the company specific valuation compared to certain, for example, portfolio management techniques where you would not value a company on a fundamental basis, but more, yeah, depending on certain technical factors. And here, for example, you see for the fundamental analysis, yeah, we look at the macroeconomic environment, industry, and the company. Okay.
May I ask a question here? Sorry.
Yeah, sure.
Um, when we have a business like Mercedes, my group has a Mercedes to analyze, and this company operates globally, so it does business in North America, in Asia, in Europe, in South America. How should we deal then with these macroeconomic factors, like the development of the economy? It's pretty complicated then, or isn't it?
Mm. No, that's a very good point. Yeah. Again, I think it depends. It depends on well, if there are big differences between the countries in terms of margins, for example, or growth, then it might be necessary to take it into regard. If, for example, the growth is quite similar in all of these countries, margins are quite comparable, then maybe you could also look at it on a consolidated basis for also for the case study, for example. Yeah, but it's always important to keep that in mind that there might be some risk factors also to that, and what we would in the case like that do is also like for the cost of capital, we could take a country risk premium into regard. So you could add a country risk premium to your WACC, which also reflects, for example, higher risks in certain areas. Yeah, but Robert, please add to that.
Well, the only thing I would add is that, again, you maybe want to first look into the actual regional scope, meaning what are the main countries, right? So although it acts globally, and that's a fair point, and that's a little bit tricky, you might want to ask, well, maybe the main region, the main global region is still Europe, right? Or there are three factories in country A and B, and therefore I look first into A and B, and then the others will follow. So again, I think figuring out what are the main important in your case countries or regions is important, and then you want to make assumptions for those, and ignore the others basically.
Okay, thank you.
Okay, yeah, here you will have a more different analysis you could perform. What's important here is that again, as mentioned before, it's really important to identify the key value drivers of your business, and you could these key value drivers, you could then look on them on an absolute basis, like absolute figures, revenues, profit. You could look at margins or relative figures, and do all kinds of analysis, based on these KPIs, these key performance indicators. For example, on a company level, you could do year-on-year comparisons. You could do plan versus actual figures comparisons, and also you could look at it on an intercompany level and compare your KPIs, for example, your EBIT margin to the typical industry EBIT margin, or to the industry, or to the EBIT margin of your peer group, your peers. You could also like do it for revenue growth. So it's really up to you to identify the key value drivers, and then yeah, do these benchmarking analyses. And what we have also here is like the normalization of extraordinary effects. It's also important to have in mind that sometimes you have quite large extraordinary effects. For example, due to COVID, or due to any other crisis, basically. And maybe you want to eliminate these extraordinary effects to make historical figures more comparable. Because you would not really plan extraordinary effects in the future. Or it's quite difficult also to plan that. And maybe you want to like smooth data and report normalized earnings, so that you could really yeah, make better comparisons with your peers if you really have extraordinary effects in your company only, for example. COVID-19, for example, you don't always have to normalize that, but because maybe all of your peers will have had the same negative effects, for example. So it really depends if you have company specific extraordinary effects. These you might want to eliminate for comparison purposes. And yeah, here again you have some sources for your business planning. And yeah, what's here important is really to always have the big picture in mind. So we told you a lot about different sources you could use, different analyses, and so on. But so you will really acquire a lot of data, but in the end, it's just important to look at the big picture and maybe take a step back and focus really on the most important things. Because you for your companies, you will find a lot of data. You will find a lot of reports, industry reports, analyst reports, historical reports, company data, and so on. And there it's really important to really focus on the most important things and yeah, keep the big picture in mind. Okay, and yeah, there's again some more sources for the benchmarking. Yeah, here again, keep in mind that you will need a peer group of comparable companies. You will need it for the business plan, and then again also for the cost of capital. So the peer group is really quite important in valuation, because you will do your benchmarking and your cost of capital derivation based on that. So it should really be a set of suitable companies with quite similar business models. And yeah, but we also know that for some companies it might be difficult to really retrieve a good peer group. Okay. And yeah, here we put together some typical questions you could ask yourself in a benchmarking analysis. Yeah, you could go through them on your own, I think. Okay. And let's now talk about well, the application then of in your financial planning. And for that, I think it's best we start with the free cash flow calculation, basically, because here you see which components are the most important ones for your valuation, for the valuation case study. And the first item would be the EBIT based on your P&L planning, on your revenue planning, your cost planning. You would get an EBIT and deduct taxes to get your NOPLATs, net operating profit less adjusted taxes. There you would add back your non-cash items, depreciation, amortization, and deduct your cash investments, the CapEx, capital expenditures. And also what's important here that you have your changes in net working capital also included here. So if you do a very simplified DCF valuation, you basically need to plan at least these components. But for our purposes, it's we will really need an integrated business plan, and that's also for you the task really to develop an integrated business plan consisting of not only these positions but also a fully fledged balance sheet and cash flow statement. But there again, please just focus on the most important line items. It's really not necessary to plan every single line item. And here you see also what we mean with integrated business plan. We tried to highlight all of the interactions between profit loss statement, balance sheet, and cash flow statement with the color coding. So if we have here, for example, the profit and loss statement with revenues and cost of goods sold planning, that would typically reflect in your current assets, in your working capital. Your working capital planning typically based on certain ratios like days of inventory outstanding, days of sales outstanding, is then based basically on revenue and your cost planning. And on the debt side, you then have, for example, the payables, trade payables, which are typically planned based on your cost planning. Yeah. And based on revenues, cost of goods sold, you would then also estimate your operating cash flow. So you see really your revenue planning, your cost planning not only affect your P&L, but also your balance sheet and your cash flow statement. And here, for example, we have a company with quite high property, plant, and equipment. And so you have the property, plant, and equipment in your balance sheet. You would plan it for the next years according to an investment plan. So you have your investments, which will be deducted in the free cash flow, and also in the normal cash flow, and investing cash flow. It's also reflected, and of course, you have your depreciation for the property, plant, and equipment. So here again, you have the PPE planning affects all three statements. And basically it's the same for interest expenses, debt financing in the balance sheet, and your financing cash flow. And what's also important, if you have your P&L, then bottom line would be your profit. Profit directly goes into your equity. And if you pay your dividends, then dividends would then again be deducted from equity. And what's also here is in the balance sheet is here your cash at the end of the year, and cash at the end of the year is basically cash beginning of the year plus your cash flow. So the result of your cash flow statement directly goes into your or is added to your existing cash. So yeah, I think this is a quite important illustration to see really how an integrated business plan works. And on the next slides, we show you here how you could plan the line items on your own, and that's also for the case study. Um, hopefully um, yeah quite helpful here. That, for example, we have here revenue planning. We have two different methods for the revenue planning shown here. For example, you could do your revenue planning on a very detailed level. If you have, for example, I don't know, 10 products in your company, you could for each product create a price and quantity structure. And then you have the revenue per product, sum it up. Or, for example, you could do it in a more simplified way by just assuming a certain level of revenue growth. Let's say you start with revenue of 100, and then you plan your revenue growth. And basically, you could do all the different line items in such a manner. There's most of the times there's a simple way, there's a more detailed way, and yeah, I think it's also best to, if you go through those slides on your own. And I will instead show you an Excel model where you can see how we would then do it in Excel. And it's also for you a first hint of how a financial model could look like. Yeah. So I go through all of these slides. Yeah. Okay. And so I'll show you now the Excel model. It's just a quite simplified financial model. You will be required to build a financial model for the case study for your business plan, but it does not have to look exactly like this one. It's just to give you an example of how it could look like. Yeah. And regarding the structure maybe of this simplified financial model, um, it's basically starts here with it starts here with or you have here different tabs in the financial model. In this version, for example, you have here your cockpit. This is the cockpit where you could yeah, do the business planning basically. So you would write your assumptions in there. For example, here regarding inflation, I have here some input for my inflation expectations. And what's maybe to so that you would understand it better. In this case, I have 3 years of historical data, years 2017 to 2019, and then 3 plan years, 2020 to 2022. And so the model basically always tells me the historical numbers, and then I plug in my expectations for the future. And that's basically how this model works. I have here again my cockpit sheet. I have here my revenue planning, for example. I have here my both methods as shown in the presentation, a detailed one and a simplified one with just some growth assumptions, or a detailed one with, in this case, just one product with prices and quantities. I have a certain cost level, for example, defined, or I could do it in a more simplified way by just assuming a certain EBITDA margin. I have a CapEx schedule where I assume, for example, here CapEx of 10, of 30, and of 0 for the next years, and then the depreciation assumed for 20 years. And based on that, I have my depreciation schedule. Yeah. And the same then for the working capital. I have here my working capital assumptions for the days of inventory outstanding, days of sales outstanding, days of payables outstanding, and yeah, have here all my my ratios, my KPIs, and the same for the financing. What's then important? This is again the cockpit sheet where I put in all my assumptions, and this then is directly linked to the business plan sheet here. So we have my business plan sheet here, and here all of the plan figures are basically linked to the cockpit, where I yeah, put in the my assumptions. And what's important here is that I have my whole business plan here, the profit and loss statement, balance sheet, cash flow statement, and yeah, some supporting analysis regarding my working capital changes, my net debt changes, and so here really it's an integrated model, integrated business plan. And so I show here 3 plan years, which basically come from the cockpit, and also I show here the historical figures. And for the historical figures, I linked it all to the input tab. Yeah, that's so this financial model structure could be applied. I tried to yeah, make it as simple as possible, and also like to try to give it a certain structure, so that not only I can understand it, but hopefully also yeah, another one who has to I don't know, to take over the project, for example, if we are in an evaluation project, so that it's also that he would understand it. And yeah. And yeah, for example, here I have my inputs with my historical data. These go in the business plan tab here. Business planning here is done in the cockpit, basically. Then I also have here a valuation tab where I perform a very simplified DCF valuation in a WACC approach with revenues, EBIT, depreciation, investments, changes working capital, which all come from the business plan, which are all based on the integrated business plan. I have here some other assumptions regarding WACC, for example, have my equity value. Yeah, included here also some sensitivity analysis, which I will show you later what it is. And then I also have here my output sheet, for example, with, again, the business plan, profit loss statement, balance sheet, cash flow statement, valuation, and these illustrations, for example, would go in a report, in a KPMG report. It's also already in KPMG formatting. Yeah. And the most important tab in every financial model is the checks tab, basically, where I have included some checks whether, for example, assets equal liabilities. Here, for example, where I only check whether the business plan is correct. That's yeah, that's basically the same, should be the same. I have other checks here, for example, if my historical figures are the historical calculated net income is the same as the net income from the historical reports and so on. Yeah, so basically that's a very brief introduction into financial modeling, and I will now go back to the slides and hand over to Robert for some examples.
Perfect. Lucas, can you share the
Yeah.
slide just very quickly? So we brought some examples and we prepared some examples for you. We have a base case, and then we have 5 different cases where we show you how you could very on a very simple basis, but still how you can reflect any of those cases or scenarios within the integrated business plan. Looking at the time, I will just go through one of the examples. We can take the first case. We'll go through the first case, and then the others are just the same with a different case or scenario, and you can look at them by yourself. Of course, if you have any questions on those other cases, then please feel free to reach out to us. So let's start with the base case. And what you see here, and I hope you can read it either on the screen or in your own slides. We have an income statement, balance sheet, and cash flow statement, right? And of course, we started with the historical actuals, which are of 2019, and then we have our estimates from 2020 onwards, right? And actually, this is also kind of what your business plan will probably look like. And this is basically what Lucas just showed you within the Excel model. So what you do is you start with the income statement, you start with the historical figures, and then you come up with proper assumptions on the future development of the income statement. So, for example, an assumption on revenue growth, gross margin, cost increases, amortization, and so forth, right? And based on those assumptions, you model your income statement, and you see the results basically of those very generic assumptions, right? The same you would do for the business for the balance sheet, meaning you start with the historical figures, you think about proper assumptions on each of the line items, and then you basically project the future balance sheet. So we have assumptions on capex, then we have assumptions on working capital days, meaning days inventory held, days sales outstanding, days payables outstanding, and so forth. And then you have your balance sheet and your income statement, and then of course you can calculate your cash flow statements, considering the net income from the income statement and the single items or line items from the balance sheet. And then you link your cash flow into the balance sheet, or cash end of period into the balance sheet, and then you link your income statement to the balance sheet, and then you have an integrated business plan. Right. So let's go to the first scenario, and this is just to see what we mean by going through the line items. So what we did here was we simulated a new market. Okay, and we can maybe we can go back to the slide before. Yeah, and then within the base case, what you have is you take your income statement, balance sheet, and cash flow statement, and then you can calculate your free cash flow accordingly, as Lucas presented before. So based on the very generic, but the assumptions and the base case, we have a free cash flow on the far right, and a free cash flow of 9, 9, 10, and 11 for the future years, right, within our business plan. Perfect. And then we start with the new market entry. This is a case where we just wanted to simulate how would our cash flows look like if we assume that our company enters a new market, right? And we highlighted the changes in blue, and we added some line items so that it becomes apparent what has changed. So starting at the left upper corner with the income statement. So we have our baseline revenue, which is basically the revenue we projected in the base case. And then, of course, due to entering the new market and buying more products, we have an additional revenue, right? And you can see that the additional revenue in blue. So this is the add-on we add to our top line. However, and this is important, and this is what we wanted to show you, you have to think about all the other consequences as well, right? So it's not only that we enter a new market and we add new revenue to it, but of course we add to a new costs to it. So for example, new SG&As or additional SG&As, right? So our profit developed or yeah developed accordingly. Um, on the balance sheet, we have the same situation. We have to think about what will change when entering the new market in our balance sheet. And here, for example, we assumed, and it's highlighted in blue, and you can see it in the balance sheet as well as in the cash flow statement. We assumed that it will be necessary to have a new office or production facility, whatever, in the new country or in the new market, right? So you really have to think about all the different aspects of this scenario. And then again, you can go to line by line and you see that your tangible assets will have to increase because you have to make this additional capex or capital expenditure or investment in year one, for example, right? And then you look at your cash flow statement, and again, this is just the result of the income statement and the balance sheet. Here you see in blue, you see the additional capex, right? And then you can look at your cash flow and compare the resulting cash flow with the previous cash flow from the baseline case or the baseline model. And what you see is that when you on the far right, when you compare the new cash flow, the minus 9, 7, 13, and 14 with the previous cash flows, right, 9, 9, 10, and 11, you see the impact on your cash flows and the valuations from entering the new market. And you see that, for example, in the first year, you have to spend a lot more capex. Again, this is just an assumption and very generic example, but you know, opening up a new sales department in the country or opening up a new warehouse or production facility, whatever. And then slowly but surely, you increase your free cash flow based on the additional revenue and profit, right? But not right away. And then what the valuation in the end will tell you, and this is quite important, the valuation will tell you whether it is worthwhile doing that, right? Because the fact that your cash flow increases from 11 to 14 in the last year will not automatically answer your question whether this actually generates value for you. Only the valuation in terms of the net present value of your investment, so to say, will answer the question whether it's worthwhile doing that or not. Because maybe your investment in year one is just too high and you cannot, you know, compensate on the higher cash flows on the longer end, right? So and again, the other cases are quite similar to that. The idea was to show you that not only how you can incorporate or reflect the business plan assumptions you come up with, but also how you can, for example, think about other other scenarios of your business plan, right? And the key message here is, I guess, you should take all the effects and consequences and implications of your scenario into account, right? Not only the additional revenue, so in this case, not only the additional revenue, the additional cost, but also the investment and any other consequence that might come with it. right? And then you can play around a little bit, and especially if you have a well-functioning Excel model, you can play around a little bit. You can increase the assumption here and decrease the assumption there, and then you can compare the cash flows and of course the valuation. Yep.
Okay. We'll go through the other cases here. Yeah. Okay. Well, then let's go to the last part. Yeah, some concluding remarks. I will not go through all of them, but just to give you some more yeah, let's call it tips or practical guidelines for evaluation purposes. What we often do in valuations, we perform so-called sensitivity analyses. So sensitivity, and also on the next slide you will see scenario analysis. These are used quite often to reflect certain changes in, for example, key value drivers, key performance indicators, and so on. And that's it's good in terms of estimating how, for example, a 1% drop in the EBIT margin would reflect in the value of your company. So it's a quite often used tool, yeah, to just show how certain parameters could affect your valuation result. And here, for example, we have a sensitivity analysis with changes in the WACC and in the EBIT margin, for example. In the base case, we would have an EBIT margin of 20% and a WACC of 8%. And then we, for example, change the EBIT margin from 20% to 10%. And you see here, for example, it has a quite huge impact on the equity value with using the same WACC. If you also increase the WACC, for example, by 1%, and then the impact is again higher, of course. And that's, for example, a typical picture you will find in a lot of valuation reports, or also in like this illustration where you would show changes in margins, in capex, for example, in the cash conversion cycle, the WACC. And what you could also do, if you don't want to do a sensitivity analysis, is you could really develop different scenarios. And scenario analysis became somewhat popular during times of crisis, for example, or also during the COVID-19 pandemic. We saw a lot of different scenarios developed in a lot of companies to reflect the negative effects, for example, from COVID, or the uncertainty relating to COVID or to other crises. Because often you don't really know how, for example, in I don't know, 3 years, the business will perform. And you could do a like base scenario, and also, for example, an upward scenario and a downward scenario, or like a stress case, for example. And it's also what a lot of banks are required to do for ECB stress testing, that they have to perform or they have to develop a stress scenario and do some stress testing. And therefore, it's good really to um, have scenario analysis where you could say, for example, in this scenario, I assume that these five KPI or these five KPIs would change to, I don't know, um, to a downward level whatsoever. So you could really play with the assumptions and develop different scenarios, and you could then also like put different weights to the scenarios. For example, you could have a base scenario, and you say, yeah, I give it a weight of 60%, 60% base scenario, and then 20% each to the downward and to the upward scenario. In the end, it's always important to remember that for valuation purposes, we need expected values. So you would really need to have the expected revenue in your revenue planning so that your free cash flow represents the expected free cash flow. And expected means um, all of your different scenarios are weighted to show the expected revenue, for example, or the expected EBIT. So you could develop, I don't know, 10 different scenarios, and then you could weigh them and put different weights on the scenarios. But in the end, you will have to say, okay, that's then the value or the weighted base case I will use for the valuation. And this is, for example, 10% downward scenario, 10% upward, 80% base scenario whatsoever. It's just a different way to basically decompose the expected value. Yeah. It's not necessary for the case study that you develop different scenarios, but maybe you will try sensitivity analysis. I think it's always a good starting point because it's quite easy to do in Excel, and yeah, you can show, for example, that changes in equity value due to a slight change in the EBIT margin or the EBIT margin in terminal value, for example, has probably the highest impact. Okay, I think that's it for today. Yeah, the other remarks are, I say, not that important. Here's something about terminal value, but I think you already covered that in the lecture with Shirin. Yeah, and we already did the financial modeling X course. Yeah, if you have any questions, please just reach out to us, drop us an email, or you could also stay in the session and we'll discuss it later, one-on-one. Okay, so it's now 1 o'clock, and that's the end of today's session. Thank you so much for listening to us, and yeah, if you have any questions, reach out to us, and yeah, have a great week, and we'll see each other next week, I think next Monday. Okay, thank you.
Thank you. Bye.
Thank you.
Thank you.
Thank you.
Bye.
Thank you.
Thank you.
Thank you.
Okay, do you have some questions?
Yes, I have.
Yeah.
Yeah, so my first question is regarding these probabilities about the scenarios.
Mhm.
And also I have seen sometimes that when somebody makes evaluation for a company, they use like DCF or DDM with some percentages.
Mhm.
How do you take them? Is it like randomly, or which are the assumptions to take these probabilities?
Okay, so you mean really to put probabilities on the DCF value and on the multiples
Exactly, and also
value?
like on the scenario analysis. I mean, you can just put like a number you want, and you just make it a reason about this. You just justify, or is it a rule?
No, we would put probabilities on the different business plan scenarios, for example. We would do that, for example, yeah, to have um, a stress case, management case, and an upward case, for example. We would put probabilities on that, and then yeah, basically have an expected value, more or less. But we would not really put probabilities on DCF and multiples. We would, for example, show the DCF result, which is based on different scenarios, for example, which are weighted. And then below that, we would show the multiples valuation result, for example.
To confirm the results that we
Yeah.
sorry, we got from the DCF.
Yeah.
And
right.
the sensitivity analysis is also for about the same purpose, is complementary to the DCF.
Yeah, we use the sensitivity analysis often to give give a range, a value range. So, for example, yeah, you don't in a valuation, you don't have to really say, okay, this company is worth 1 million, 0.0. So really the exact figure. Often or most of the times, actually, we would say, yeah, based on a DCF valuation and all of the assumptions we made, we would estimate a value between, let's say, 0.8 and 1.2 million based on a DCF, and the multiples results of, let's say, 1 million to 1.4 million confirm our DCF result. Something like that more.
Okay. And last question, and this will be really quick. When we don't have publicly traded companies, I assume that you had many cases to validate companies without that are not traded. I mean, what's the case there? Or if there are investors that they want to analyze these companies, that they're not collaborating with the company, how can you
Yeah.
evaluate these companies?
Well, often you have, or yeah, mostly there are due diligence is performed. So you have a financial due diligence, for example, and the financial due diligence team, KPMG also offers these services. They get access to certain private data because the selling company is also interested to show to investors how they perform and so on. So they are interested really that their data is yeah, well, brought to investors. And for example, the due diligence team would go through the private data and write a report and also comment on the business plan the company developed, for example. And in the valuation, then we could use the business plan from the management and calculate the DCF value based on the business plan from management in a very simplified way. And also, like if we receive the business plan, then we can do benchmarking. We can say, no, I think the EBIT margin is too high. Let's reduce this. Let's reduce it to industry levels and so on.
But the company must provide the data to,
Yeah.
the.
Yeah. At least historical financials, and then you could do a simplified planning on your own. But yeah. Let's say in most of the valuations we perform, we receive a business plan. And we do more of a plausibility assessment of the business plan. We say, yeah, compared to the peers, it looks plausible, but yeah, we don't really create or build business plans for all of the valuations we do.
Okay. Okay, thank you very much.
Okay. Okay. Do we have more questions?
Hello. Yes, I do have
Yeah.
a question. I just wanted to ensure that I stood correctly. So for the next session, we were actually required to prepare 2 or 3 slides with the cash flow projection, etc., which are basically what Robert showed us, is the base case. So you have basically the cash flow sheet, you have the balance sheet, etc. So I was just wondering, because we are talking about the business plan. In the next cases, the adding cases, whether it's a new market entry or a capacity increase, etc., is it something that we all have to do, or is it something that we can see, okay, what fits, what makes more sense for the company that we got signed for, that we basically choose the next cases, the onboard cases?
No, for the next session and also for the valuation, you would need one case. You would need, in this sense, a base case. So you would develop a base case scenario, or your scenario, what you would expect. And you don't need to show it like Robert showed it before. It's more, next session is more about that you explain how you develop the business plan, so that you tell us how you develop the revenues, what's behind your assumptions, for example, and therefore it would be great to have some benchmarking, for example, that you say, yeah, I have peer group of, I don't know, these 5 companies, or I know that in the industry we have EBIT margins of 20% according to this report, whatsoever, and so that you gather data, and based on the data, on the benchmarking data, you could also use analyst report data from Thomson Reuters, or I think Refinitiv is called now, or Capital IQ, and you could then say, yeah, okay, um, I think that for the next years, my revenues are, I don't know, the average of my peer group growth and industry growth, whatsoever. So really gather data on the most important positions, line items, and then develop the business plan based on that. And also in your presentation, you could, it would be best if you just write down the main assumptions for the main line items. For example, revenues, margins, yeah, your investment plan, your capex, and also maybe some assumptions regarding working capital. So really the most important positions. Yeah.
And then later on, we will cover the other examples of like whenever, or because I didn't quite understand whether these cases with new market entry, working capital
No,
optimization, etc.
that's not required. No,
Okay.
it's just for you and to show you how
The
you
grasp.
could, or
Okay.
how such changes would be reflected in a business
Okay.
plan. Yeah.
Okay.
But
Okay.
no, it's not required. No.
Okay. Thank you very much. Thank you for your time. Have a nice day. Thank you.
You too. Okay. Do we have more questions?
Just a comment if there's nothing else.
Yeah.
So we will, for the next time, for the next assignment we have, we will apply the things we've done today in our companies, right?
Yeah.
And we just, okay.
That's the idea behind it. Yeah.
Perfect.
But you don't really have to perform everything we showed you today. It's more really about identifying the most important.
The main idea.
Yeah, the main idea, the most important parts, and yeah, it's really that you try to develop an integrated business plan with profit loss statement, balance sheet, cash flow statement, and that you have sound assumptions for the most for the main parts like revenues, margins, yeah, investments, financing.
And
Something like
also
that.
like the Excel that you showed us, you haven't uploaded, right?
No, that's just an example of
Example, okay.
how it could look like. Um, the problem would be if I give you the Excel, there you would have the links, and that's basically what what you are required to do in the business
Okay.
plan to really yeah, put the links between your P&L, balance sheet, and so on,
The
and
formulas,
connect
like
it. Yeah, the formulas, and say, I don't know, cash in the balance sheet equals cash
okay.
from last year plus
Okay.
cash flow.
And we have to make again a presentation in a PowerPoint, like not with not the Excel.
Yeah, you can show, for example, the business plan tables, like P&L, balance sheet, cash flow statement, and just table account. I don't know, historical figures, plan figures, and would be great if you just write down the main assumptions on the PowerPoint slides.
On the
For
slides.
example, yeah, you can also like show the historical performance, historical KPIs like historical revenues, historical revenue growth, historical margins, for example, and maybe also like some benchmarking. Peers have historical margins or projected margins of yeah.
Okay,
Of
so
that and so.
we'll work on the Excel, then we will transfer it to the
Yeah.
PowerPoint. Perfect.
Yeah.
Okay. Thank you very much for the
Okay.
explanations.
Thank you. If you have any more questions, just drop me an email. That's also fine. Okay. Well then, have a great day and see you next week.
Thank you.
Okay. Bye.